BD8 Capital Partners CEO Barbara Duran and Ariel Investments Vice Chairman Charlie Bobrinskoy join us now. Guys, happy Friday. Barb, how much do you factor in the president's saber rattling on tariffs here with the markets, big tech, NVIDIA, all hitting these record levels and perhaps the risk rising again that maybe this time he really is going to be serious about these higher tariff levels?
Yeah, well, John, the risk is always there, but I think the market is clearly telling us that they think it's a lot of, as you said, saber rattling, that he's shown that he backs off from these draconian threats. And I think that's clearly the assumption this week. I mean, you saw that when he announced Canada last week, and the market briefly had a swoon and then came right back. So I think there's a big discounting, which I think is a little bit risky. I think the rates will come down, like copper at 50% when we import 50% of our copper, and it's so important in so many industries, construction, semis, renewables, et cetera. So I think the market is discounting that won't be much. However, there still is a risk. We have to see, it should be starting to show up a little bit in the second quarter earnings, what's happening with tariffs. I mean, the tariffs at the effective rate of 14% didn't really start to kick in until May. So second quarter earnings might actually be better, than expected, which right now it's looking to be less than half of what it was for the first quarter.
Charlie, we know you're all about value, those value stocks, and it's been comparatively maybe a bit of a rough go at times. But I'm curious what you think about what Goolsbee said about potential tariff impacts with what the White House has been saying lately and how that affects interest rate policy perhaps from here, and then how that affects the rest of the year for value stocks.
So Goolsbee is the Fed chairman in Chicago, and he's always been pretty dovish, which means that he puts more emphasis on unemployment than on restricting inflation. And he clearly signaled that he thinks it's getting close to time to cut rates. I think there's more of a split today on the Fed in terms of what policy should be than I can remember. I think we've got almost exactly 50-50 split of 50% of the people thinking that interest rates are unnaturally high and need to come down, and 50% of the people worried about tariffs and their inflation effect. So hard to make that call, but it's very much up in the air.
All right. So, Charlie, because we've talked about the yield curve over the years, I do want to get your insights now as Rick Santelli was laying out this bear steepening that we're seeing, especially as we go into bank earnings next week.
Yeah, so this is one of my complaints. People think that the bond market is omniscient, that whenever there's an inverted yield curve, you're going to have a recession. I heard for years about how that was an infallible indicator. I don't think that bond investors have any particular crystal ball on the future. Right now, we are getting a steepening in the yield curve, which is generally considered positive for the overall economy. When people are worried about a recession, the folklore is that you get an inverted yield curve. A positively sloped yield curve is very good for banks. Banks borrow short and lend long. So that's true for investment banks. It's true for commercial banks. It's good for bank earnings. So I think fundamentally the banking sector is benefiting from what's going on with the yield curve.
Barb, what do you think? Whether it's financials, which have had a big run up ahead of next week, or some of these other parts of the market, for example, mega cap tech, which we know has really pulled out into the lead again.
Right. Well, I think both are interesting. I think Charlie's right. They're big beneficiaries, of a steepening yield curve. In addition, the economy, while it's weakening on the edges, we're seeing it in all sorts of economic data, although there's conflicting data on that, that's good for the banks. And so I think that, that even though the mega cap banks are up in a big way, like JP Morgan is at 2.5 times book, which is at the very high end of its valuation, you still have some of the mega regional banks that look interesting and are cheap. So I think there are still opportunities there. And of course, in the mega cap tech, I think, I have continued to be a bull there. And I think even though they've had a big bounce back from their lows, they still have a lot of room to run because these are very long running pathways of growth. And so I think there is normal pullbacks in this. We see this periodically profit taking, but this is where the play is. And also they're relatively invulnerable to tariffs, with all that uncertainty there. And if you look at what's happening pre-earnings, we start, as we all know, next week with the banks. Some 60% of positive pre-announcements or positive indications are from the tech names versus, say, industrials, it's about 14%. So I think there's still a lot to go here, and their earnings reports should be solid.